This is the Asia Trade. I'm Shery in Tokyo. The top stories this hour. Asian stocks set for a cautious open as oil rallies, stoking concerns the Fed will have to raise rates this year. The yen weakens with intervention efforts proving short-lived. Nvidia falls as it teams up with Wall Street giants to invest $500 billion in AI infrastructure, but with few details on timing and structure of the deals. And President Trump makes sweeping new demands on Iran, dimming hopes of a quick deal to reopen the Strait of Hormuz.
I'm Haidi, Stroud-Watts in Sydney. Take a look at the setup for trading across Asia. And as Shery alluded to, we're looking at a pretty muted start to trading this Tuesday. A little bit of gloom coming through from the fact that we haven't had sort of new resolutions, progress-wise when it comes to the US and Iran situation. In fact, President Trump making these sweeping new demands, putting the idea of another temporary ceasefire a little bit further out of reach. But take a look at the setup as we had tech stocks off by about 0.3% at last trade. That's leading through to a pretty weak start when it comes to trading in Korea. We're also seeing Chicago Nikkei futures looking quite flat at the moment. We'll be watching for the impact of dollar yen. At 159, we have erased about half of the gains that we've seen post-intervention, weakening by 1% to end out the session. This is the worst performance out of the G10 peers in FX on Monday. So given the sort of lack of sustainability of these intervention gains, traders are on alert for potential further support from official channels. But switching out the board to take a look at the geopolitical story, because oil continuing to hold these gains again for a third, going into a fourth day after we heard from President Trump making these new demands on Iran that really clouds the outlook for a deal to reopen the Strait of Hormuz at a time when we were hearing that perhaps Iran and Oman were getting a little bit closer to finalizing that agreement. Trump has now demanded compensation for all the people they have killed in conflicts that he says after Tehran also reiterated requests for reparations. So, Shery, when it comes to geopolitics, we're not getting any closer, it seems.
Yeah, when it comes to the Asia stock market, we'll also be watching the tech trade, of course, very closely, especially when it comes to the AI infrastructure build-out. Nvidia now tapping Wall Street giants for $500 billion to finance the next wave of AI infrastructure. The coalition brings together some of the world's biggest investors to fund the computing power, data centers, and AI factories that Nvidia says will power everything, every industry in the years ahead. Bloomberg Technology Senior Executive Editor Tom Giles joins us now with more on this. And Tom, we're talking about Wall Street giants like Goldman Sachs, BlackRock, Blackstone, Apollo, so many others like KKR. Doesn't necessarily sound just like another chip partnership. How significant is this?
Well, it's some of Wall Street's biggest names, some of the biggest names in finance. And what they are trying to do is put a stamp of approval, if you will, from Wall Street on some of these transactions that Nvidia is involved with some of the other big tech firms. As you're well aware, the amount of money that it needs to be invested in AI infrastructure boggles the mind, and it's also caused a lot of concern in the markets over how much is being spent and how quickly we're going to see a return on those investments. Nvidia is at the center of many of these transactions. They're being characterized as circular in nature. The idea is that Nvidia will make an investment in a company, or and that company in turn will buy Nvidia's products. And so the concern is that should demand not materialize as quickly as hoped, that could result in some kind of something catastrophic for the industry. So the more companies you have, like Apollo and others, BlackRock, Blackstone, putting their necks on the line, the more that should give the market a bit of a sense of reassurance that they're all in this together. Nvidia's not alone. It's got backing of some of these really credible financial services companies. And so that's the message that they're trying to send.
It's interesting because there's sort of louder murmurs of potential concern coming from credit markets, right? Which, of course, is typically where you start to see the simmerings of discontent. But you're saying, Tom, potentially this is supposed to add confidence. It could actually create a bit more fear.
Yeah, I mean, what you're seeing is the technology industry getting really, really leveraged, taking on levels of the debt that you haven't seen in a long time. And so what's happening is that, these are companies that have traditionally been able to reinvest in operations without necessarily taking on too much debt. That certainly is changing. And the idea here is that there is so much demand for these advanced chips. Remember, Nvidia is the leader in the most advanced chips that are needed for training and also, starting to make inferences based on the data that you've built into these large language models. They do have a strong leadership position in these chips. And what they tell us time and time again, quarter after quarter, is that the demand is insatiable, that there are so many people who want and are willing to pay for these chips. It's a question of where does the money come from and how much is Nvidia putting itself on the line in order to make that happen. And now it has all these partners from Wall Street to join it in those efforts.
At least finally, are we seeing how AI capex could be translating to returns? I mean, in this earnings season, for example, we saw investors really giving support to stocks like Microsoft and Amazon, but then punishing others like Alphabet, for example.
Yeah, it's the question is, will there be that end user demand for all of the tools that are being generated and the information and the services, the coding, for example, the building of agents, the ways that these services are supposed to change the way we do business, whether it's everything from insurance to fund management to HR, one industry after another. Entertainment is being disrupted by these end services. Again, though, the question is, will that demand justify the investment? And don't forget where you're sitting right there in Asia. What we have seen over the last several weeks is the development and the advancement of Asia, China in particular, their ability to create large language models, create tools that are being a competitor to Anthropic and OpenAI and Gemini and XAI, et cetera, these large, the US leaders. And so as you see more competition from China, for example, what is that going to do to end user demand for all of these tools, that all of this investment, these trillions of dollars that are being invested in AI infrastructure, if China can come along and do it more cheaply, well, are we going to see the return? And is this money well spent? And we want to know, we as investors are saying, we want to know that the risk is going to be mitigated and the risk will be distributed over multiple parties. And again, when you bring in David Solomon and Larry Fink and leaders from Wall Street, that is meant to say, yes, we are sharing this burden. We believe in the AI infrastructure build. We believe in Nvidia. We believe in its ability to meet demand. But we also recognize that in order to fulfill all of these obligations, it's going to need financial help. And some of that's going to take the form of debt.
Tom Giles, really great to get your perspective. Bloomberg Technology Senior Executive Editor there. And these are some of the other stories that we're following in the AI space. The SEC has eased the path for data center operators to issue asset-backed securities. In a letter to a law firm late last month, the agency said data centers are physical infrastructure assets, not financial assets like loans or leases, meaning some securitization rules will not apply. The move could help unlock more funding as Wall Street looks to finance a historic build-out of data centers and AI infrastructure. Intel shares fell after announcing plans to raise $15 billion through a stock offering, the first public share sale since it listed in 1971. The proceeds will help fund AI initiatives and purpose-built silicon while supporting general corporate needs. The offering is also expected to strengthen Intel's balance sheet without adding to its debt burden. Anthropic has formed a partnership with Macquarie Asset Management and Singapore Sovereign Wealth Fund GIC to develop AI data centers in the U.S. The companies say Macquarie and GIC will provide most of the funding, while Anthropic has agreed to cover any consumer electricity price rises linked to the facilities. They didn't share any details on planned spending or the size of the projects. Meta has introduced a new downloadable AI model called Muse Glimmer that can run on a personal computer. It's a distilled version of the company's Muse Spark 1.2 model. CEO Mark Zuckerberg says Muse Glimmer is designed for efficiency to minimize system requirements, allowing it to be powered by just one graphics card. Haidi?
Shery, we've got some breaking news crossing the Bloomberg. This is a story that we've been watching quite clearly, with Intel set to sell $15 billion in stock after we've seen the boost in demand from the AI story. Now we're hearing that Intel is set to target at least $95 a share in a $20 billion share sale. They upsized that share sale, said to be drawing more than $100 billion in demand. According to this, Intel is also said to be weighing pricing shares at about that 6.5% discount. So we are hearing a few more details about this, looking to increase the amount that it's raising to a share sale, about $20 billion, a third more than was initially targeted. Let's have a closer look at how we're viewing sort of the prism of trading today. Of course, we're also watching the yen after it weakened around 1%, wiping out half of the recent intervention rally, leaving traders on alert for further official support. Let's bring Bloomberg MLive strategist Mark Cranfield with us. Mark, let's start off on what we're seeing with the yen. And I guess it surprises no one who understands, obviously, central bank dynamics and the differentials that have been at the core of this, that this is happening.
Well, basically, there's been radio silence from the Bank of Japan over the past couple of weeks, and that's really why the yen has started to weaken again. So you've heard from Japanese officials, they've intervened, they've confirmed that. Scott Bessent has had a lot to say from the US side, even President Trump has weighed in. And we haven't had a word from anybody senior at the Bank of Japan. And clearly, the fact that monetary policy is not yet aligned with the intervention story on the yen, that's the big problem in terms of why the yen is giving up so much of the gains which we saw at the end of July. So until investors are convinced that the Bank of Japan is ready to move interest rates higher on a quicker timescale than they were before, it's not going to support the yen for very long. We have 3 speakers scheduled from the Bank of Japan before the meeting in September. Unfortunately, they tend to speak in a fairly neutral way. Investors don't have high expectations that they're going to drive home the message that an interest rate hike is needed at that September meeting. Traders are pricing just over 60% odds at the moment there will be a 25 basis point hike. But we often see those odds just shrink as you get closer to a meeting. So for now, it looks as though October is a possibility. Bloomberg Economics have certainly gone that way. They see that as a real chance of a hike then, but that's too far away. If you're a foreign exchange trader and you're saying to me there's not going to be any change until October, and then the rate only goes up to 1.25 when you've got a neutral rate fully expected to be around the 2% threshold, and you have the risk that the Federal Reserve may need to tighten rates. We heard from Beth Hammack again today saying that more than one interest rate hike might be needed from the US. So the interest rate story is still there. Rate differentials are very much in favor of other currencies, particularly the US dollar, and there the yen is languishing. And on top of all of that, Bloomberg is running a story today suggesting that the ammunition to defend the yen is not as big, is not open-ended. There are caps on how much they can spend in the market from the US side and from the Japanese side. Traders will be well aware of that. So they're not fearing too much in terms of there may be more intervention, but not on the scale that is going to make a huge difference. It all comes down to the Bank of Japan and whether they want to raise interest rates quickly. And for now, that doesn't appear to be the case.
I'm really curious, Mark, if we're going to get some sort of action from authorities here, given that we're on a holiday here in Japan, and of course the Obon summer holiday is coming up. Mark, I need to ask you, so yesterday I had a conversation with the growth strategy minister, Kiuchi, and he kept emphasizing how Japan's fiscal policy is not expansionary, that they really care about debt sustainability. They have now veered this view from the government on trying to gain discipline on the debt to GDP ratio instead of just a primary balance. When it comes to these inflation concerns, inflation always helps with the debt to GDP number, right? Also, assumptions of GDP growth that could be more positive. When it comes to the backdrop that we're in, where oil prices could continue to rise, will just the BOJ hiking rates do enough at a time when we also have fiscal policies like consumption tax cuts that could act on really turning market sentiment more sour?
Yeah, you're absolutely right. Fiscal discipline, or the lack of it, is a major issue, not just for Japan. It's pretty much a global thing now. Ever since the United States became a lot more lax on how they rein in their spending, they don't seem to have any cap at all on how much they're willing to spend, how wide they're allowing their fiscal deficit. The rest of the G10 has pretty much followed the same track. There's been some exceptions. Australia is doing a better job than some. But in general, not many countries seem to care about trying to match the numbers between spending and raising revenues. And so you've got these fiscal gaps all over the place. Growth is okay, but it's not enough to offset these huge deficit numbers. And then you've got a country like Japan. Inflation is relatively high. It's stabilizing, but it's not going to offset the big demands that they have on spending and continuing to do so. Clearly, Prime Minister Takaichi wants to get Japan back into the kind of situation it was under Prime Minister Abe, where Japan is growing above its traditional rate, and that will boost demand across the country, expand the economy, and it will help the stock market, and the yen eventually gets the benefit of all that. But that's a long way off. If you're a foreign exchange trader today, you're not going to be waiting for a couple of years until the Japanese economy is growing at 3% or something higher than that. So these words are all very interesting, but investors will take it with a pinch of salt. They expect to see action in the near term, and that's not very likely. If you have a country like the United States who is not giving global leadership on reining in fiscal spending, there's no reason for anybody else to take it too seriously. And at the same time, as you say, with oil prices going up again, people know there's going to be increased spending to bring in the energy supplies. Japan is very vulnerable from that point of view. At the moment, it doesn't add up. There is nothing on the horizon in the near term that is going to support the Japanese yen unless the Bank of Japan do it. Japanese economy will start to do better. They're getting great investments as well from their tech sector. TSMC from Taiwan is doing another new plant in Japan. So all of that is working, but it doesn't do much for the Japanese currency.
Bloomberg M Live strategist Mark Granfield there. Well, still to come, President Trump makes sweeping new demands on Iran. We take a look at what it means now for efforts to reopen the Strait of Hormuz. This is Bloomberg. President Trump is calling for Iran to pay compensation for damage and deaths caused in the conflicts across the Middle East. The sweeping demands were made in response to Tehran's request for reparations for the US and Israeli war. They also sparked a rally in oil prices that left stocks wavering, bond yields climbing. Let's bring up Bloomberg Politics editor Laura Davison, who joins us now for more. And Laura, it feels like we're taking steps away from sort of the precipice of getting to this ceasefire deal.
Yes, we have almost officially entered silly season here, where we have each side sort of bringing up new and different asks rather than narrowing down, to get closer to a deal. You have Iran demanding reparations, and then Trump, sort of firing back, saying, if you are that, so am I. Saying that he would also wants, reparations essentially for U.S. individuals killed in the region for the past 50 years or so. I'll note that the original ceasefire deal, if you go back a couple months, did have this $300 billion fund for economic development in Iran. It's not clear if that's exactly what the Iranians are talking about here, but we are, have now really, are just sort of, firing off from both sides new demands, signaling that we're nowhere near closer to some sort of deal coming together. Forget to mention, even, in the Strait, a narrow deal being negotiated between Iran and Oman. That still remains elusive, though both those sides say they're closer to something that would allow at least some traffic to come through, though not the completely free and clear traffic that Trump has talked about.
It's interesting because we seem to have this kind of new strategy where the president is happy to try and let the economics of the situation pressure Iran.
Yes, this has kind of been a new tack that he's adopted in the past couple days here. He, said he's, quote, low-keying it with Iran, and that they're only semi-negotiating, and he essentially wants to let economic pressures, play out. We have seen, that, Iran, continues to face high inflation, and, as it's, unable to get oil out, of the strait, at least in large numbers, that will affect the country, economically. But it's not clear that that's going to be the death knell that Trump, has suggested it might be, that their entire economy might collapse, and that would lead them to some sort of surrender in this war. We've seen other economies, Russia, for example, be able to withstand these sanctions far longer, at far more, high levels. North Korea, for example, is the same, and that may not, be a winning strategy, at least, in some sort of short-term win for the president here before the midterms.
Does he need that short-term win? How's the domestic situation? Is the heat sort of starting to get turned up as we head closer to those midterms?
Yeah, you're starting to see, more angst, particularly among Republicans on the Hill. This war remains increasingly unpopular. And as we've seen, oil prices continue to stay high, even, today, back up to $88 a barrel. And domestically, gas prices, are up well above $4 a gallon. This, it continues to really weigh on voters. And this is something that Republicans are quite concerned about, but they, don't really see a way out of this war. So instead of, talking, about the war and how it might become to a close, you see Republicans essentially running away from this issue on the campaign trail, looking to talk about the tax cuts that were passed last year or finding any other way to change the subject.
Bloomberg Politics editor Laura Davidson there with the latest. We do have more ahead on the Asia trade. This is Bloomberg. Shery, with every day we continue to see these risks and concentration and volatility grow when it comes to how investors are viewing the AI and AI adjacent space, right? And we've talked at length about what's been going on in Korea, which has really led to some of these regulatory concerns over particularly the single stock ETFs that we've seen in this space. Today's big take looks at exactly that, the fact that we're seeing increasingly these AI-dominated leverage ETFs continuing to rattle the markets. The growing share of equity leverage that's riding on the same AI names that we've been looking at. Many of them have now been seeing some really historic swings, right? We're talking the likes of Samsung, of SK Hynix in the Korean market in particular. So this has just been sort of one demonstration that we saw that frenzy of speculation, billions of dollars being poured into these ETFs, tracking just Samsung, just SK Hynix, and just sort of pouring fuel onto the fire of the AI-driven rally. The acceleration of the rally certainly happened, but then we saw quite a powerful reversal, right? Those declines were equally as potent when sentiment reversed. So just so much risk being built into this particular platform.
And it's really interesting because you're seeing a lot of these leverage bets being on AI names. In fact, Bloomberg analysis now showing that roughly 800 bullish leverage equity ETFs show 58% of exposure now is AI related. And it's interesting because they're also bullish bets. The exposure has quadrupled since 2022. So bullish leverage ETF exposure rising from about 123 billion just a few years back to 280 billion in 2024, and just last year to almost $500 billion. And Haidi, you talked about the risks. The core one is a concentration versus individual stock liquidity, because so much leverage is just focused on a handful of AI stocks. And of course, subscribers can get more on the AI-dominated leveraged ETFs in today's Big Take. Big Take Go is the function. This is Bloomberg. It's been really interesting, Heidi, to see the development of the AI narrative, right? I mean, we started with, is there enough demand out there for artificial intelligence and everything that comes around it? And now it seems to be, yes, there is. So can you actually translate that into an actual infrastructure build out? And then with all of that CapEx, bring some returns home. When it comes to the infrastructure build out, though, it's also about the financing, right? Who will fund all of that? And we now have this new partnership between Nvidia and a ton of these mega banks in Wall Street. We're talking about the likes of Goldman Sachs, BlackRock, Blackstone, KKR, Apollo as well. So Nvidia essentially helping finance the buyers of that compute that's going to be needed in this new AI world. We're not just talking about risks being about leverage, more dependent on perhaps private capital, but also the fact that circularity concerns abound anytime we talk about Nvidia. They are really providing the financing backing that helps customers fund chips and data centers, which in turn also supports Nvidia's revenue, while of course increasing that concentration across the same ecosystem. But we'll have to continue watching how Nvidia is really increasingly becoming also a capital provider when it comes to building out this AI ecosystem and infrastructure.
Yeah, and does that really kind of just add more discomfort to the worries and the risks that investors have already identified, right? You talked about the circular financing conundrum, and now we're seeing these big Wall Street players also getting into it as well. It's a similar kind of thing that we saw with situational awareness, where we saw just a few days after a near implosion of that fund, we're seeing kind of the Silicon Valley insiders coming together to back it again. Does that give much confidence to broader investors? If you take a look at credit markets, perhaps not. You're starting to see kind of the indications of worries playing through there. But at the same time, there's obviously a lot going on outside of the tech sphere as well, right? We're watching Iran. It seems like we're getting further away from a deal as opposed to closer, which had been the optimism over the past couple of days. But if you take a look at oil prices continuing to hold most of those gains over the past 3 to 4 days, we've now got both Iran asking for reparations, President Trump also asking for new demands on Iran as well. So it doesn't look like we're anywhere closer to getting a deal. US futures looking pretty lackluster at the moment. The Aussie dollar is unchanged as we head towards that RBA decision, where they are expected to keep rates unchanged today for a second straight meeting. Of course, it is kind of an interesting macro environment to be dealing with at the moment. We're expecting the RBA to restate the readiness to tighten further and tackle stubbornly strong inflation. Joining us now is Goldman Sachs Chief Economist for Australia and New Zealand, Andrew Boak. Andrew, really great to have you with us. So, you know, hawkish hold, I guess, is the expectation. But what is the RBA waiting for here? Because it's a difficult situation where you've got the big fall in property prices. How that's going to feed through to broader sentiment gauges is obviously the big worry. But inflation has been pretty sticky for a while now.
Well, good morning, Heidi. Thanks for having me on. Look, we're expecting a hold today. And as you say, I think you've correctly characterised it, a hawkish hold. And the key catalyst for that is inflation. And I think most importantly, the June quarter inflation report that we got a couple of weeks ago, and digging a little bit deeper into that report, I think there were some encouraging signs there. I mean, you're right to highlight, and I think the RBA will highlight today again, that inflation is too high, but it is moving in the right direction. So if we're looking at the RBA's favoured trim mean measure of inflation, in that June quarter report, we saw a third consecutive quarterly deceleration in inflation. And if not for the oil price spike related to the Middle East, inflation in trim mean terms would have annualised in the June quarter pretty close to the top of the RBA's 2 to 3% target band. So I think it's good news there, consecutive downside surprises vis-a-vis the RBA's forecasts. And I think compositionally, they would be encouraged, even if they don't say it so explicitly today, that some of the pass-through that we feared from the oil price shock hasn't come through in quite as pronounced ways as we were really worried about. So we're not out of the woods by any stretch, but I think that that inflation print was really the catalyst. Now, especially as it's happening against the backdrop, as you say, of this sizable adjustment in the housing market, and I would say also in the labour market, where we're starting to see the unemployment rate increase, underemployment rate increase. Both those things are happening a little bit faster than the RBA's expecting. And so I think that can make them feel comfortable that that the disinflationary pulse we've seen is a sustainable one going forward. So we think the RBA is probably the door is probably closed to further rate hikes this cycle, but that they'll sound quite hawkish or cautious, I would say, and that they'll deliver a hawkish hold later on today.
Yeah, let's talk a bit more about the property market, because clearly the tightening cycle plus the tax changes have been pretty potent. Do you expect further downside, particularly when it comes to places like Melbourne and Sydney?
Absolutely, we do. Our base case hasn't changed since May, and that is that prices at the national level will fall by 5% to early next year. I think the downside risks to that base case have increased, and that certainly in Sydney and Melbourne we'll see much larger adjustments lower. And that is an important part of the puzzle because, as you said earlier, inflation has been sticky in some subcomponents, but if house prices continue to adjust in that way, I think it's likely to cap the upside risk to, say, house construction costs, which is, the largest subcomponent of the inflation basket. And I think, this is really an important piece of the puzzle for the RBA as they try and engineer a soft landing and bring inflation sustainably back to target.
I don't want to draw too close comparisons between China's property market and Australia. Obviously, there's lots of structural differences, but the one thing that was very evident was how closely tied household sentiment, retail sentiment, consumer sentiment is to household wealth, which is obviously held in property. Is that largely also the case here, and do you worry about that pass-through?
It is a very important channel of monetary policy. Higher interest rates, lower house prices, negative wealth effect, slower consumption growth, and that's exactly what we're expecting to see more evidently over the second half of this year. And so on the base case, our base case that house prices fall peak to trough around 5%, we think that'll take roughly 100 basis points or so off consumer spending growth, which is currently tracking year-on-year rate of around 2.5%. We think it'll roughly halve over the back half of the year, and that falling house prices is an important piece of that puzzle. I think where I'd sort of caution about being too negative on this is just that from a financial stability point of view, I think Australia's in a fairly robust position, courtesy of 10 years of macroprudential policy, responsible lending rules, the Royal Commission in the banking sector, which has, I think, built resilience into the financial system, created buffers on household balance sheets, and should allow the Australian economy to sustain quite a sizable adjustment in house prices without it sort of presenting sort of a disorderly adjustment to the broader economy.
We're having this conversation on Census Night, of course, and it sort of makes you ask a lot of questions about how well Australians are doing economically, financially, compared to maybe when the last census was done, right? You see a lot of the political campaigning around how poorly Australians are doing. Do you think things are actually that bad if you kind of look under the hood?
Well, if you take the consumer sentiment surveys at face value, then people are pretty down in the dumps. That said, we've found empirically there's not actually a very strong correlation, recently at least, between those soft consumer sentiment surveys and actual consumption, which has been quite resilient. I think you're right to highlight, some households are certainly under pressure, and at a micro level, this tightening cycle will make life very difficult for some households, and particularly the period of high inflation, which is particularly damaging for those on lower incomes. But overall, let's take a step back. The economy is growing. Let's take a step back. The unemployment rate has a 4 handle on it, which is historically low. And so I'd caution against sort of the doomsday scenarios on, just the Australian consumer and the broader economy.
Andrew, always great to have you with us. Andrew Boak is the Chief Economist for Australia and New Zealand at Goldman Sachs with us, and subscribers can also turn to the terminal for more on this. TLRV Go is your function for the latest updates, commentary, analysis from our expert editors as we head towards RBA Decision Day. Shery.
And Haidi, it's a holiday here in Japan, but we're watching the Japanese yen, which has given up about half of the rally that we saw after the joint intervention in the currency space by Japan and the United States. The growth strategy minister now says government spending plans will provide a long-term boost for the yen. Speaking exclusively to us here in Tokyo, Minoru Kiuchi also pushed back against market concerns over the nation's finances.
I think I would like to stress the fact that this does not represent a retreat from fiscal discipline, and we are shifting from the rather, abstract concept of fiscal consolidation towards a framework that places greater emphasis on the more economically grounded and international standard concepts of fiscal sustainability and debt sustainability.
All of the spending right now that's expected, including the consumption tax cut, for example, that's raising concerns. Which tools does the government have available and funding alternatives if you're not going to borrow more?
We review both revenue and expenditures, and we also review, as I told you, some fundings and special taxation measures. Through this, I think it's not so difficult to secure 5 trillion yen.
Is fiscal policy right now in Japan, which is seen as very expansionary, going to be able to achieve that goal?
Japanese fiscal policy is not so expansionary as you think, because we put great importance on fiscal sustainability. So it's, some people say that Japanese fiscal policy is very expansionary, but it is not true. We will stick to the fiscal sustainability. And as Prime Minister Takaichi stressed, the fact that regarding the consumption tax reduction on food and non-alcoholic beverage, she won't issue a new JGBs. So I think there is some misunderstanding.
If the BOJ hikes rates and the yen still weakens, how problematic will this be for the government? And could you reconsider perhaps some of the fiscal plans, which right now are thought to perhaps be destabilizing investors and market sentiment towards Japan?
I would like to stress the fact that Japan's fiscal position is improving. Responsible and proactive public finances is a policy aimed at strengthening Japan's supply capacity and productivity while attracting greater investment into Japan. As investment in Japan and yen-denominated assets increases, demand for the yen will naturally rise, as I mentioned. I therefore do not see responsible and proactive public finances as a policy that leads to a weaker yen. And on the contrary, I believe it can put upward pressure on the yen. Lastly, our aim is to achieve both a strong economy and fiscal sustainability in an integrated manner. Please believe me. That is the essence of responsible and proactive public finances and the core of this historic shift.
Japanese Growth Strategy Minister Minoru Kiuchi speaking exclusively to us here at Bloomberg. We have more ahead. This is Bloomberg. Asian bank stocks are staging one of their strongest rallies in decades as investors rotate their bets amid growing uncertainty around the AI trade. Asia Equities reporter Winnie Su joins us with more on this. And Winnie, we have seen the Topix Banks Index, for example, here in Japan, rallying 40% year to date already, partly because we have a tightening central bank as opposed to many parts of the world. What's driving this outperformance of banks across Asia?
Yeah, good morning, Shery. Well, just as you mentioned, we are seeing this actually part of this global phenomenon. In fact, we did see U.S. banks, European banks also pretty strong. But everywhere you look in Asia, we do also have our own reasons of bank shares rallying. You just mentioned where you are in Japan, that BOJ bets. But also, let's say where Haidi is in Australia, we're also seeing Australian banks pretty strong on that economic outlook where we saw very strong consumer spending boosting these domestic logistic-related sectors where banks really drove the broader index to a record high just last week. And beyond that, where I am based, which is in Hong Kong, we're also seeing bank shares rising on those attractive yields and the more active IPO activities. Then you look a bit more south, where we see for India, the credit cycle is really turning upwards, as well as corporates and retails taking up more loans, as well as Singapore. Just last week, very positive, the earnings driven by the wealth fees and that wealth boom that we're seeing. So we saw wealth fees at record highs, and these major banks in Singapore at record highs as well. Now, overall, these are the different individual factors, but that rotation away from AI, as well as the bets that most likely we are going to see a more favorable rate environment, are also some of the positive factors.
So elaborate a little bit more on not just the bull case for financials across the region, but also perhaps the bear case.
Yeah, so in fact, we just talked about kind of that rate outlook being part of the factor that we're looking at. So overall, financials have been quite strong because of that reduced fear of a rate cut. But at this point, in fact, we just had the Friday's U.S. jobs data coming in a bit softer. So that kind of revived a bit of a fear that maybe we potentially will see further cuts to come. So that part is something that we will be closely watching out for. And that's why Wednesday CPI data will be quite important. And beyond that, then there's also kind of the comparison with tech right after that big correction. People are seeing a bit more attractiveness when it comes to the tech shares, given that when you look at earnings, it's still way stronger than financials. And when you also look at the price, it's actually not that much more expensive compared to financial shares. So we're hearing some of the investors saying that after this big rally we saw in financials, maybe we can potentially see a bit of a rotation backwards into tech.
Bloomberg's Asia Equities reporter Yie-Hsin there with the latest on financials. And of course, we continue to watch the AI trade and those tech names across Asia as well, especially when it comes to South Korea. Japan today away on holidays, but do keep an eye on the Kospi futures right now, pointing to some downside with Samsung Electronics, SK Hynix potentially seeing a little bit of pressure. Of course, in the overnight session, we had Nvidia under pressure as well after they announced that $500 billion Wall Street AI financing platform. A big scale up of the entire AI capital stack. We're talking about partnering with the likes of Apollo, Blackstone, BlackRock, Brookfield, GS, and KKR. Nvidia, of course, has relationships with both SK Hynix and Samsung Electronics. We're also hearing from President Lee Jae-myung really wanting that Honam semiconductor cluster to be finalized very soon. So we'll be watching all of the governmental developments on that front as well. But let's discuss what the setup for Asia looks like on this Tuesday and bring in markets reporter Anthony Stevens. Anthony, of course, I mentioned the Nvidia deal, but we also have Intel's first public share offering since their public listing, in the 1970s or so. How does this really come through into the Asia session?
Yeah, let's go through the numbers on Intel really quickly. So it can be upsized to around $20 billion. That's about 2 times the normal ADV of the stock, which has been much higher in recent days. The pricing is around 6.5% discount, which compares kind of favorably with a 4% 1 sigma move in the stock. So the deal is tight and it is very well oversubscribed, but it is a big deal. $20 billion to absorb at this stage in the AI cycle is a lot of money. And it'll be interesting to see how the stock trades after market. It was weaker into the announcement of the deal. Now, going back to Nvidia, what is interesting here, and that ties in all the concerns that you mentioned, is concerns about capital discipline. Nvidia becoming the banker of choice to the AI ecosystem is not what shareholders signed up for with that stock. And it's very similar to the Korean situation, where shareholder return is becoming a much bigger facet of go-forward expectations from retail. And as a result, you're seeing this weakness early in next trade in Samsung and Hynix, as it appears that the AI ecosystem remains extremely committed to high levels of capex versus shareholder return. So that debate is really strong on the hardware side, and it's coming at a time where the software side of the AI trade is doing really well. So, for example, again last night you saw the software space in the US trade really well. You're seeing HS Tech in China trade really well, Tencent, Alibaba, and other kind of China hyperscalers. So the focus has moved from from hardware to software because of the capex concerns and the spending concerns around the hardware side. And that concern will not be alleviated by the capital raising you're seeing today.
Japanese equities aren't trading today, obviously, but we're firmly watching the yen, right? The fading of those gains, I don't think surprises anyone. Do we see more intervention?
Yeah, on a fundamental basis, you did see the reaction function on the yen from the oil move. It continues to be the dollar side of the trade driving the bus, because the conviction on the yen side of the trade that the MOF or the Japanese in general can do anything about it, aside from raising rates, is very low. You saw a big retracement in US dollar JPY vol as well, from about a 10 handle back down to 8 handle. That is very historically low. So no one is really playing for any kind of aggressive strengthening here, as long as the USD side is driving the bus. Now, we move into US inflation in the back end of the week. That seems to be a much bigger driver of where the yen will go than anything Japan does or says. Now, in terms of the intervention and what they can do, there's also a question about what are the goals of the intervention. Maybe the goals have already been reached, in that one-way speculation in the yen has been dented. So it remains to be seen in terms of go-forward communication, how much more Japan wants to say about intervention, having made a dent in speculative positions here.
Bloomberg market reporter Anthony Stevens there. We do have more ahead here on the Asia trade. This is Bloomberg. The latest from the corporate front now, and Mark Zuckerberg has published a 6,500-word essay on artificial intelligence, emphasizing his belief that wider access to AI models is key to the industry's future. Meta's CEO says he still supports open source AI, and sources challenges the notion that concentration of power in a few companies can ensure safety. It comes as the company introduces a downloadable AI model that can run on a personal computer. The IPO of China's Unitary Robotics has drawn huge demand from retail investors, with almost 10 million orders, leaving the retail portion subscribed more than 5,500 times. The Hangzhou-based company sold more than 40 million shares, raising about $904 million. The mainland's first listed humanoid robot maker is expected to debut on Shanghai's Star Market this month. Well, the market opens are ahead in Sydney and Seoul. No trading for equities today in Japan, but of course we are on yen intervention watch again, as we continue to see this fade in the yen's gains following the last round of joint intervention, erasing half of those intervention gains now. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens as we're watching these macro trends compete with the AI trade in order to really dominate that equity narrative. Heidi, of course, we're talking about being ahead of the CPI numbers out of the U.S., which will be very important given rising oil prices. But at the same time, we have this $500 billion partnership between Nvidia and Wall Street giants.
Just this great big ball of funding and money for AI, right, continues to dominate the narrative, as you say, even as there's so much in terms of other themes going on. We have no further progress when it comes to talks between the US and Iran. In fact, we seem to be further away from progress, with more demands being made on both sides that are unlikely to be met. But at the same time, even when Japan equities isn't trading, we've still got plenty of action when it comes to the yen.
Yeah, I mean, we're talking about the Japanese yen giving up about half of the gains that we saw after the U.S.-Japan joint intervention. it was the worst performer among the G10 in the overnight session. Actually, I just recently spoke to the growth strategy minister here in Japan, Kiuchi, and he was telling me that fiscal policy here in Japan is not that expansionary and that actually spending will support the Japanese yen. But as you can see right now, we continue to see the downside pressure, and we're headed back towards that 160 level against the US dollar. And now we have also more realization that perhaps what the Treasury can do in the United States in order to support the Japanese yen, to support Japanese authorities, is not as much as it was previously thought. We're talking about the Exchange Stabilization Fund only having around $200 billion. And remember, in this latest round of intervention by Japanese authorities, the single largest day of intervention was around $50 billion. So that could run out pretty quickly. Take a look at how South Korea is coming online. Of course, Japan is away on holidays, but we're watching those tech stocks in South Korea. Given the Nvidia news, given the fact that Intel is also offering public shares for the first time since they listed in 1971. So anything related to AI, anything related to the tech space will be on watch. The cost is down more than 1%. And of course, we're also following the export numbers out of South Korea for the first 10 days of this month, rising 45.3% year on year. The export part of things is also very important. The chip export part of things, which is a gain of 155% year on year. So really coming to support some of those economists' expectations. Bloomberg surveyed economists, and they had all upgraded the growth forecast for South Korea to 3.3% for this year from 2.8%. And Haidi, a lot to do with those trade numbers.
Yeah, and we have, of course, when it comes to trade, need to look at the Singapore economy. This is a very externally vulnerable economy. We are getting the final second quarter GDP reading there, rising 5.9% for the second quarter, slightly better than previous expectations of 5.8%. They've also raised their 2026 GDP growth forecast, the estimate, to between 4.5% to 5.5%. That is a big uplift from the previous 2 to 4%. That final quarter GDP, they're rising by 1.4% quarter on quarter. Again, stronger than the previous reading of 1.2%. So a pretty strong uplift there that should translate through to some optimistic trading for the SDI when we come online. We have also had the MAS coming through with its latest round of policy tightening as well, slight as it was. There are still some ongoing concerns as to what the implications of the Middle East tensions could be, elevated energy prices, inflation. But as we can see from that overall GDP number, the financial property sectors looking pretty well positioned, and that also came through from some of the latest bank earnings that we've had from the big Singapore banking giants as well. Let's take a look at what else we're watching in these markets. I mentioned, of course, the lack of progress in the geopolitical situation in the Middle East. That's being reflected in oil prices, really holding that advance as we see these retaliatory sort of tit-for-tat demands from Iran and the US really clouding the outlook for a reopening of the Strait of Hormuz, which at one point over the past few days looked like Oman and Iran were getting closer to that deal. But now President Trump demanding compensation from Iran wanting reparations for war damages as well. So all of this is getting muddled and into what is ultimately looking like a pretty hardened stance between the two parties. Nonetheless, we are seeing a little bit of upside in trading in Australia. These stocks are pretty close to record highs still. Modest gains of about 0.25%. The Aussie dollar is also holding above that 70 US cent level. The RBA is expected to come through with that hawkish hold. But, interestingly, that boost for the Aussie from here could actually come through from the yen rather than any other factor.
And Haidi, we do have breaking news at the moment. More AI deals. We're talking about Anthropic having struck a $9.1 billion deal with Riot Platforms. This is a Bitcoin mining company that also recently began selling AI data center capacity. Now, people talking to Bloomberg saying that the deal is for 191 megawatts of capacity from Riot's Rockdale, Texas campus and runs through June 2048. Now, Riot expecting the contract to generate $9.1 billion in revenue with an option to extend the contract and potentially reach $16.1 billion in total assets. Just leading that narrative again that we continue to see a lot of these deals around artificial intelligence in order to secure capacity, in order to secure power as well when it comes to building out the AI infrastructure landscape. Let's bring in our next guest, Grace Tam, Deputy Asia CIO at BNP Paribas Wealth Management. Grace, all of these AI deals, whether it's around Nvidia, whether it's around using Wall Street giants for private capital, Anthropic as well, Does this give you any pause when it comes to the potential circularity of all of these companies investing in each other that could lead to more market volatility, that could lead to risks ahead?
Yeah, I think, that could lead to some kind of market volatility. But at the same time, we still see a lot of very good opportunities from the AI theme, especially for the recent earnings results. For example, for the hyperscalers, I think before the results, a lot of concerns about the hyperscalers capex and whether they can achieve the ROI. But at the end of the day, especially when we look at Microsoft and also Amazon, their revenue growth actually outpaced their capex growth, which is a very good sign for the hyperscalers. And also as a lot of the hyperscalers, they continue to increase their capex, right? That's actually benefits, a lot of the AI upstream build out picks and shovels stocks.
When it comes to really increasing the capex, Alphabet didn't necessarily do very well after reactors reacted negatively because of the disappearing free cash flow. So when it comes to investing opportunities, would you still go to these hyperscalers or to some, as you said, the picks and shovels, and where are they?
Yeah, I think we have to be selective in terms of the hyperscalers. Some of them are really good, and of course some of them are not. And also for some of the picks and shovels, I think we also have to be selective. And going forward, as we mentioned earlier, volatilities will stay high, but at the same time, we still see the trend of the AI continue.
When you say being selective, are you talking more about regions and different ecosystems, or are you talking about individual stocks? And are there any regions and countries that potentially provide more upside, given that some markets have already seen that huge run-up, like South Korea, Taiwan, for example?
Yeah, I think in terms of regions, of course, like U.S., the North Asia, the China, Korea, and also Taiwan, they still have very good potentials, and especially after the AI washout in July, a lot of the leveraging positions is already unwind. So we think actually, especially we think the corrections. The very deep corrections in July is more about the crowded and leverage positioning rather than any major changes in terms of the fundamentals. The fundamentals, as we can see from the earnings results, actually continue to be very good, and earnings very strong, and that leads to valuations. Valuations actually still, when we look at the PE, because earnings going up, prices also go up in line, and valuations actually remains very reasonable.
Grace, before we let you go, of course, we do have eco data again coming to the forefront, especially with the U.S. CPI numbers. It could be key when it comes to the cross-asset trade later this week. What numbers are you expecting, and what impact will it have on the Fed? Because we are now positioning for potentially more tightening, given, of course, higher oil prices as well.
Yeah, I think for market consensus for the upcoming headline U.S. CPI is like a month-on-month 0.1% increase, and that's actually a rebound from the minus 0.4% last month. So basically, market expect some kind of pickup in terms of the CPI. But if it turns out to be less than that or higher than that, of course, that will affect especially the market expectations of the future rate path. So we have to see.
Yeah, and we'll really have to gauge that one, right, given that we did have softer U.S. jobs data. Grace Tam, good to have you with us, Deputy Asia CIO at BNP Paribas Wealth Management. Haidi.
Well, Nvidia, Shery, as we've been talking about all morning, tapping Wall Street giants for $500 billion to finance the next wave of AI infrastructure. The coalition bringing together some of the world's biggest investors to fund computing power, data centers, AI factories that Nvidia says will power every industry in the years ahead. A Bloomberg managing editor for tech and cybersecurity, Lynn Doan, joins us now for more. And Lynn, at a time when broader investors are questioning just a sheer amount of spending that's gone into AI, we really see these big players doubling down.
We really do. And, you know, honestly, I was hoping for a little more detail than we got after the initial report on this $500 billion investment plan. Even after the Nvidia announcement this afternoon, we still don't know what the timing of these investments might be, what the structure will be for the financings, and how much of the plan goes beyond the string of AI deals that Nvidia and the Wall Street firms have already made. I think that, as you hinted at, this is going to continue to drive concerns about the so-called circular AI deals that Nvidia has been linked to over the past several months. It's inked hundreds of billions of dollars worth of deals with companies across the entire AI ecosystem. And that's, of course, stoking some concern from investors that the chip-making giant is inflating demand and valuations for AI startups across the board.
Yeah, Lynn, and what does it tell you about the evolution of Nvidia's business itself, given that it's now becoming this capital provider when it comes to its own end market?
I think it tells you that a lot of Nvidia's success and the perception of it on Wall Street hinges on this AI boom continuing to boom. And the market is going to be very sensitive to any signs that might suggest otherwise. And so it is very much in Nvidia's interest to ensure that the boom continues. And this is one of the many ways of financing and investing that Nvidia has demonstrated to sustain that growth.
Bloomberg's managing editor for US East, EMEA Tech and Cybersecurity, Lynn Doan there. More ahead here on the Asia Trade. This is Bloomberg. Well, President Trump is calling for Iran to pay compensation for damage and deaths caused in conflicts across the Middle East. These sweeping new demands were made in response to Tehran's request for reparations for the US and Israeli war. They also sparked a rally in oil prices that left stocks wavering, bond yields climbing. Our Bloomberg correspondent Rosalind Matheson joins us now. So it feels like we are actually taking, further steps away from the possibility of a deal being done. It felt like we were much closer a few days ago, but now these tit-for-tat requests seem very unlikely to yield compromise.
Well, that's right. So it feels that we take two steps forward and then another step at least back. So there was a sense that things were moving perhaps towards a deal, especially brokered through Oman. But now again, we have this broadening of demands and in a really unclear, unspecific way around reparations and damages. So Iran saying we want reparations for this war in order to allow shipping through the Strait of Hormuz. Donald Trump replying to say, well, the US wants reparations too and damages for a whole lot of different things. He's saying that, the killing of protesters dating back decades in Iran, damage to countries including Lebanon, Yemen, Syria, Gaza. So all of that is really hard to set parameters around to negotiate. So it just shows again how difficult it's going to be to get to a deal, let alone any kind of conversation at some point that really properly addresses Iran's nuclear ambitions and some of its weapons, and just showing the US that getting out of this conflict is going to be very, very difficult, and that Iran has perhaps a vested interest in keeping these negotiations dragging on as well.
We know that the Iranians on their side, they can be very patient, they can be very willing to wait and tolerate the pain. What about the economic pressure? Because this seems to be President Trump's new strategy, right? Saying that he'll just wait it out because those pressures are mounting on the regime.
Well, that's right. So now he's saying instead of threatening to go back to open warfare, he's saying that he can take a low-key approach and use economic pressure. But we've seen, again, this is a regime that is very hardened to lots of different kinds of pressure. It's a regime that has been under sanctions, heavy sanctions, for many years. It does have the ability to withstand that pressure, to find workarounds, and certainly a regime that's willing to tolerate a lot of pain from its citizens in order to sustain itself. And so does economic pressure really work on Iran? It's pretty difficult to say. In turn, though, you are seeing perhaps some economic pressure coming on the US in this, and for Donald Trump, that big question of where are we on price pressures, where is this conflict going as he gets ever closer to those midterm elections in the US.
It's been quite interesting, right, because we know that the economic picture and those pressures are coming down on President Trump as he gets closer to the midterms. In the sense that, that is building domestically, is that going to make much of a difference, do you think, to, I guess, a level of willingness for him to come back to the table?
Well, certainly he's got an incentive to have this not escalate further and to have really extreme price pressures coming onto the US economy into November, and that's really a full resumption of this conflict. But the question is there any kind of proper off-ramp for him at this point? Is there a foreseeable off-ramp for him at this point? And that's very unclear. So perhaps the best option for Donald Trump at the moment is to take it to that lower boil, to have it simmering, and not a lot of shipping maybe getting through the Strait of Hormuz. Perhaps some shipping does get through the Strait of Hormuz, and you've got at least less pressure potentially coming on the US economy, because as we've just seen, these negotiations are going to take time. They are very complicated. So that path is going to be very slow. Neither does a full resumption of war. That's not a very positive step for the US economy. So perhaps keeping it just on this lower ball might be the best outcome from Donald Trump for now.
Bloomberg's Rosalind Matheson there with the latest on the Middle East, and more ahead here on the Asia Trade. This is Bloomberg.
Japan on holiday today, but we're watching the Japanese yen under pressure and giving up about half of the gain since the Japan-US joint yen buying, a historic first since the 1990s. We're very close to that 160 level, which could be the next policy test. Could we see more intervention at that level, given that we do have open holiday thin liquidity that is an existing risk? Japan's growth strategy minister now saying that the government spending plans will provide a long-term boost for the yen. Speaking exclusively to us in Tokyo, Minoru Kiuchi also pushed back against market concerns over the country's finances.
As you know, we had a very prolonged underinvestment, and based on the basic policy which was approved by the cabinet meeting on the 12th of July, we would like to try to achieve a strong Japan's strong economy on one side, and on the other side we would like to strengthen the fiscal sustainability. We think both are very important.
We are talking about consumption tax cuts on food and beverages. We're talking about having to spend still this year, next year. How do you fill that fiscal hole?
Yeah, I think I would like to stress the fact that this does not represent a retreat from fiscal discipline, and we are shifting from the rather, abstract concept of fiscal consolidation towards a framework that places greater emphasis on the more economically grounded and international standard concepts of fiscal sustainability and debt sustainability.
All of the spending right now that's expected, including the consumption tax cut, for example, that's raising concerns. which tools does the government have available and funding alternatives if you're not going to borrow more?
We review both revenue and expenditures, and we also review, as I told you, some fundings and special taxation measures. Through this, I think it's not so difficult to secure 5 trillion yen.
Is fiscal policy right now in Japan, which is seen as very expansionary, going to be able to achieve that goal?
Japanese fiscal policy is not so expansionary as you think, because we put great importance on fiscal sustainability. So it's, some people say that Japanese fiscal policy is very expansionary, but it is not true. We will stick to the fiscal sustainability. And as Prime Minister Takaichi stressed, the fact that she, regarding the consumption tax reduction on food and non-alcoholic beverage, she won't issue a new JGBs. So I think there is some misunderstanding. Under these policies, the public and private sectors will collaborate in bold and strategic investment in crisis management, which minimize a range of risks, and growth investment, which will enable cutting-edge technology to flourish. So we won't invest, for example, massive state money to produce mango or another fruits. We will invest in the fields, as I told you, such as AI, quantum technology.
If the BOJ hikes rates and the yen still weakens, how problematic will this be for the government? And could you reconsider perhaps some of the fiscal plans, which right now are thought to perhaps be destabilizing investors and market sentiment towards Japan?
I would like to stress the fact that Japan's fiscal position is improving. Responsible and proactive public finances is a policy aimed at strengthening Japan's supply capacity and productivity while attracting greater investment into Japan. As investment in Japan and yen-denominated assets increases, demand for the yen will naturally rise, as I mentioned. I therefore do not see responsible and proactive public finances as a policy that leads to a weaker yen. And on the contrary, I believe it can put upward pressure on the yen. Lastly, our aim is to achieve both a strong economy and fiscal sustainability in an integrated manner. Please believe me. That is the essence of responsible and proactive public finances and the core of this historic shift.
Japanese Growth Strategy Minister Minoru Kiuchi speaking exclusively to us here at Bloomberg. And of course, if you missed any part of that conversation, the Bloomberg Video Hub is your site. Subscribers can explore live streaming, news, interviews, all our Bloomberg TV shows, documentaries, analysis as well. Bloomberg.com/videos is the address. And do keep an eye on the markets right now. A little bit of divergence. Japan away on holidays, the Kospi trending down, and then you have the ASX 200 trading sideways as we expect a second straight hold from the RBA. This is Bloomberg.
Take a look at how we're tracking in Asian markets. And of course, we've got a great deal of uncertainty when it comes to the Middle East situation with both the US and Iran. Trading demands that look increasingly unlikely to be fulfilled or get to any point of compromise as that reopening of the Strait of Hormuz remains a little bit further away now. We are seeing just modest upside when it comes to trading here in Australia. Well, Taiwan will be in focus after a raft of tech headlines and strong TSMC sales. Taiwan has been taking attention from Korea on the back of a very strong earnings season. Let's bring in Anthony Stevens for more on this. So we are seeing Korea drifting lower again. What's top of mind for you?
It's interesting that Korea is moving into a dynamic of spot down, vol down, right? So there's less concern about the kind of slow drift, but also there's significantly less excitement in Korea. This is from both retail and foreigners. It's really remarkable that foreigners have basically unwound that $5 billion that they bought into the big pop in Kospi. And that's remarkable in the sense that there's no momentum from foreigners whatsoever, while retail has lost its kind of excitement, and that's driving volatility lower. So Kospi vol was trading, the high 90s, high 80s, and now it's sub 70 this morning. So that is a dynamic that is worth watching. It's a kind of a proxy for the excitement in Korea. And you're also seeing that under the hood. You see today, for example, you have the oil names in Korea rallying for obvious reasons, but also the bio names. And that kind of diversification is not positive for an index that is so heavily weighted Samsung and Hynix. Also, the Kosdaq has been doing really well versus the Kospi as Korean retail rotates some of their gains and winnings in the Kospi into the Kosdaq, which is materially smaller. So there's no way the Kosdaq can support the kind of gains that the Kospi gave off in the first place. But it seems like that's a safer haven for speculation for Korean retail. So under the hood, the rotation dynamic does not suit Samsung and Hynix upside. The ball market is also pointing in that direction. And it really will take a turning around in the shareholder return narrative around Samsung and Hynix to change the narrative here. It also might imply that there's more to be done on the tech side of things, and that's why the build-out from Nvidia and other hyperscalers is going to be so important to watch for Samsung and Hynix going forward.
So what's the difference with Taiwan then? Because just last week we saw Taiwan ETFs, for example, the likes of Franklin Templeton's Franklin FTSE Taiwan, seeing record inflows. So I thought perhaps the Kospi, Samsung, SK Hynix heavy, Taiwan, TSMC heavy. So what's the difference here?
What's interesting is that Taiwan retail has kept the faith. So Taiwan margin balances have ticked right back up, and they've got a lot of fundamental support. It's been a cracking earnings season for Taiwan. Across the entire AI semiconductor space, they've seen limit up moves across multiple sectors. Yesterday, we saw, for example, in the AI power and AI chip space, there were multiple limit up moves. And that has supported the retail sentiments. They are getting the upside from the earnings. It's a little bit of a different situation from Korea, given that it's a diversified ecosystem of players, and TSMC has such a market-leading kind of dominant position, and they work so closely with Nvidia and other makers of chips. And this other makers of chips is going to be so important as a driver, because these other custom chips are trying to reduce their memory usage by working with the likes of TSMC and MediaTek and other Taiwanese names. So this optimization of memory, moving away from the memory shortage, is ironically helping Taiwan. And the progress the Chinese are making in terms of their LLMs being more resource efficient is also helping Taiwan. Taiwan makes a lot of these connector kind of chips, passive chips, that are not so in great demand and don't have this shortage. So it's more visible what the demand looks like. Lastly, the market is smaller. TSMC is big, and everything else is very high beta and can be moved around by these kind of foreign flows that are tourist. Taiwan does need to be worried about the increase in the size of these foreign flows, because they come out as easily as they come in, and with Taiwan having a limit down mechanism, that could be a risk going forward.
Our markets reporter Anthony Stevens there in Hong Kong. Let's get you caught up with some of the top corporate stories that we're tracking. And Intel shares fell after announcing plans to raise $15 billion through a stock offering, the first public share sale since it listed in 1971. The proceeds will help fund AI initiatives and purpose-built silicon while supporting general corporate needs. The offering is also expected to strengthen Intel's balance sheet without adding to its debt burden. Anthropic has formed a partnership with Macquarie Asset Management and Singapore sovereign wealth fund Yie-Hsin to develop AI data centers in the US. The companies say Macquarie and Yie-Hsin will provide most of the funding. Anthropic has agreed to cover any consumer electricity price rises linked to the facilities. They didn't share any details on planned spending or the size of the projects. Mark Zuckerberg has published a 6,500-word essay on AI, emphasizing his belief that wider access to AI models is key to the industry's future. Meta CEO says he still supports open source AI and challenges the notion that the concentration of power in a few companies can ensure safety. It comes as the company introduces a downloadable AI model that can run on a personal computer.
It's a 30 billion parameter dense model that runs on your laptop, and it's the highest performing model of its size. In the coming weeks, we are also going to open the weights for MuseSpark 1.2, our latest foundation model and one of the leading models in the world. And we've got even bigger models that are coming soon too.
The IPO of China's Unitary Robotics has drawn huge demand from retail investors, with almost 10 million orders leaving the retail portion subscribed more than 5,500 times. The Hangzhou-based company sold more than 40 million shares, raising about $904 million. The mainland's first listed humanoid robot maker is expected to debut on Shanghai's Star Market this month.
Now, the CEO of State Street Investment Management says the U.S. economy remains in good shape, but they're keeping a close eye on signs of weakness in the labor market. Yie-Hsin says that is what should keep the Fed on hold for the rest of the year.
We think that the economy is in pretty good shape, although from our perspective, we believe the Fed really should hold steady on rates, and that's what we're calling for the balance of this year. But to the extent the Fed does move, and it's already indicated it has a more inclination to move faster, but gradually, we think the economy is robust still, but at the same time, where our worries are on the labor market, and so that's why we view interest rates being steady is the better case.
What are you so concerned about with the labor market? It's been kind of this no hire, no fire paralysis really for a while.
Exactly. And, you know, I think with the Friday report, it showed the labor economy being a little bit weaker. It's not a really strong source of inflation. And it's really that inflation picture that guides us to say this is not a time to be raising rates.
You know, there's a big discussion right now in the Federal Reserve and frankly in markets about artificial intelligence and how inflationary it's going to be versus the productivity boom that a lot of people are talking about. We're seeing, for example, the idea that you are seeing growth continue to accelerate even with some of the inflationary components tied to labor, for example, come in. What are you seeing at State Street in particular of how you're deploying some of the AI tools, the efficiency versus the cost?
You know, I think it is still early days for a lot of companies. I mean, clearly, every single company is investing heavily, as we are at State Street. Where we see tremendous opportunities is with, you know, very significant processes, data-intensive, sometimes very manual efforts, enormous efficiency gains. But we also see revenue opportunities, too, as we think about streamlining our investment process, post-trade, if you will. And then also customizing to clients, being able to provide what we do for very, very large institutions all the way through to individual investors.
We've seen already the financial industry contract a little bit on a headcount front. I just wonder from your vantage point, how you think about the growth of State Street as it surpasses $6 trillion and its footprint, its headcount footprint, in response to the greater efficiency that you can do? Is it just grow the assets by keeping the footprint the same? Is it potentially shrinking the total size of the employee base versus the overall assets?
You know, we see AI as just an enabler, enabling our people to be able to do more. And so we don't see this really as a headcount reduction play, but more so a benefit to being able to serve our clients even better on a global basis.
State Street Investment Management CEO Yie-Hsin hung there speaking with Bloomberg Surveillance. Let's take a look at what's going on when it comes to some of the energy names that we're watching. Clear upside there as oil continues to hold on to these gains as hopes fade of a quick deal to reopen the Strait of Hormuz. We're now getting these new demands from President Trump in retaliation, really, from the reparation demands that we've seen from Taiwan's side as well. Trump now demanding compensation for deaths and damage in these conflicts. And this hardening stance clearly takes us a few steps away from that progress that was seen in the last few days. We're seeing some pretty strong gains there. Santos here in Australia trading high by almost 4.5%. We're also seeing Woodside Energy up by over 3%. As, of course, it is also RBA decision day, that hawkish hold expected from the Reserve Bank today. Coming up next, staying with the commodities and metals space, Sunrise Energy Metals unpacking the outlook when it comes to scandium mining. Those operations in focus after it secured a $400 million investment from the Trump administration. We have more details ahead. This is Bloomberg. Let's take a look at shares of Sunrise Energy Metals in the morning session. We're just about 40 minutes into the start of cash trading. We are seeing still that upside being shown across the 3-day view there. Big jump on Monday, obviously, on this news that it secured a $400 million loan from the Trump administration, and that deal is to expand production of scandium. It's a rare earth element critical to the military and aerospace industries. The chairman and top shareholder Robert Friedland told Bloomberg earlier that this agreement could secure the West supply for decades to come as Washington moves to diversify supply chains away from China.
Particular asset is based in Australia. It's big enough to supply all of the Western world's demand for 30 or 40 years. So this is one element that we have in the Western world that no longer has to be produced or sold from China.
Let's get some more on this with Sunrise Energy Metals CEO Sam Riggall, who joins us now from San Francisco. Sam, really appreciate you coming on for us. Obviously, it's been a big couple of days for Sunrise and for your team there. Tell us, what can you add in terms of what we heard from Robert overnight? What are the real implications of this loan and this relationship with the White House and the Pentagon?
Oh, look, it really underwrites the future of this project and global scandium supply. This is one of those metals that has been subject to really strict export controls from China for almost 2 years now. The market is extremely tight. What the US government Department of War funding gives us is a 25-year loan facility that will allow us not only to build the mine, but in the end also expand it to meet growing demand from industrial customers and defence applications. And this market is growing fast.
If we take a step back, scandium is not a metal that people would necessarily be familiar with. It's obviously very niche, but can you tell us about why it's critical and the importance of it in a broader sense?
Yeah, sure. It's an amazing metal in that it has almost absolutely no use by itself in any application. Its real value is in alloying it or combining it with other elements. So the major volume use for scandium in the market today is in solid oxide fuel cells, which are a really elegant, beautiful solution for power generation in AI data centres. And it's certainly found its niche in the last few years in being able to provide readily deployable power for the AI data centre build-out. So that's the main volume application. What we're also seeing, though, is that in the last few years, a real uptick in the interest for aluminium scandium alloys used in aerospace components, and in particular in 3D printing. It is the most effective printable metal that exists today for aerospace applications. It has a weight to strength ratio that's about 4 times that of structural steel, but with the light weight of aluminium. So very, very functional and useful for aerospace, particularly defence applications. And then the third and probably not high volume, but certainly strategically critical is the semiconductor industry. Our transition from 3G broadband to 5G was made possible solely by scandium and the addition of scandium into radio frequency filtering chips. So that's a critical industry, particularly as you look at the build out of telecommunications networks to higher and higher frequencies.
The history of this asset's interesting, right? It's been held for quite some time, and at one point it was a nickel project until the market sort of didn't stack up. What has changed to this point? And I guess, given those changes, how reliable is the outlook?
Yeah, look, this is one of the largest nickel cobalt deposits on the planet as well. That sits right adjacent to the scandium resources we're planning to mine. The nickel market is oversupplied. There's an enormous amount of Indonesian production, and that project stays on hold for now. But the beauty of that nickel resource is that there's this very high-grade system of scandium that reports right on the edge of it, which is concentrated up over millions of years, making it one of the highest grade concentrations of scandium in the ground that's been found on the planet today. And as Robert said, we've got a mine plan that envisages roughly 30 odd years of initial production from the mine site, but there's enough resource there at high grades to last many more decades, if not over a century.
We obviously heard from Robert Friedland a few hours ago, and it was, he's obviously got a major stake in this. Was it his relationship with the White House that sort of got you to the table in the first place?
No, it wasn't based on relationships. We went through a very formal process under a variety of funding programs, and not necessarily just this one that was eventually set upon. But what in the end was clear was that the Department of War recognised the criticality of scandium in a whole range of defence-based applications and industries, and was very keen to support it. We announced a partnership with Lockheed Martin earlier this year, or late last year, which is really focused on bringing high-performance alloys to a number of the Lockheed systems. We're actively engaged with the defence sector on qualifying scandium for use in printable alloys. We've worked very hard here over, well, it must be 2 years now, in trying to build a base and a foundation for an understanding of where scandium sits in these supply chains. And unlike many metals, it's in many cases non-substitutable. You have no alternatives if it is not available. I think a lot of the success that we've had, that has just culminated now in this announcement, really has been driven by the decisions by China to place quite severe export restrictions on the metal. It's really focused people's minds. It's pleasing but not surprising that this was the outcome.
Through that lens, do you think this Australia government should be bankrolling more of these projects? A lot of the funding obviously coming from the US for rare earth assets in Australia. For that sort of national security element, should we see more domestic funding? And also I'm curious if other rare earths and niche metals are sort of being forecast as well. Is this kind of the start of a new Ivanhoe?
Yeah, it's a good question. I think Australia needs to start looking a lot more clearly about how it benefits from its critical minerals policy. In our case, we've made the decision that in addition to building the mine and the refinery in Australia, we will also build a metallisation plant, and that will be built in the United States. The reason for that primarily is that most of the customers for scandium metal, the chip industry, are located there, and it makes sense to be there. But also, we also announced as part of this funding package an intention to list this company on a US exchange. So we see it's really important for our growth to be close to our customers and have access to deeper capital markets than we can sort of achieve in Australia. And this will become really what is a very defence industry focused company over time as we make investments downstream. We've already announced that we've invested directly in semiconductor development in the United States that's based on scandium technologies. We're looking also at different areas around alloy development with the defence contractors. So the value of owning and controlling raw materials has never been more important, and the downstream is prepared to play with the owners of those resources to look at options and opportunities for vertical integration. So to us, that's a really positive thing, and I think it's something Australia could also benefit from as well on a national scale.
Sam, really great to have you with us. We appreciate your time. Sam Riggall, who's the CEO at Sunrise Energy Metals. We have more on Australia Ahead every Tuesday at 10:40 a.m. if you're watching in Sydney, 8:40 a.m. if you're catching it out of Hong Kong. More ahead on the Asia trade. This is Bloomberg.
Hong Kong's competitiveness as a financial center is about to be tested by two opposing forces that promise to transform its asset management industry. A landmark tax reform designed to attract overseas asset managers is widely expected, just as China slaps a 20% levy on cross-border capital gains. Bloomberg Opinion columnist Shery joins us now with more on this. So it seems to me that China is sort of removing that tax advantage for mainland wealth, right? What would the implications be then for Hong Kong?
I think it would be quite tremendous because Boston Consulting Group did a wealth study earlier this year, and they found that of all the cross-border wealth that the Hong Kong manages, about 60% originated from China. Now, I'm not saying that all the money from China are private wealth, right? A lot of it is mutual funds buying into the Hong Kong stock market, but a substantial chunk came from wealthy mainland Chinese, and they have to somehow pay 20% tax of all the capital gains that they have accumulated over the last 20 years. And that intuitively means that they have to sell some assets. And that means that Hong Kong's private wealth management industry will have to see a shrinkage in the total amount of wealth they manage.
So how fast can they diversify away from mainland money?
And that's where the landmark tax reform is coming in. And it's super generous. So for all the funds deciding to relocate to Hong Kong, the carry interest, they don't have to pay any taxes. And in addition, performance-based compensation at the employee level, basically bonuses that the fund employees that they get, they don't have to pay any taxes either. So what we have already seen is that global hedge funds have been moving to Hong Kong. They don't necessarily trade Hong Kong stock market, but they do like the zero tax regime and being close to China's deep talent pool. And I think this landmark tax reform could help help Hong Kong diversify.
Bloomberg Opinion columnist Shery there with her latest piece. Let's take a look at what we're watching here in Australia. Of course, it is RBA decision day. That hawkish hold is largely what we're expecting. Of course, the inflation has remained sort of stubbornly sticky, but we do have sort of some conflicting messaging from the property sector, which has obviously seen home prices take quite a nosedive, particularly in capital cities, and that's going to likely feed through to consumer sentiment readings. At the moment, though, we are seeing some upside when it comes to the equity session. Energy, the outperformer there, and the Aussie dollar holding above that 70 US cent level. This is Bloomberg.